Does Medicare cover braces? And unfortunately, Medicare does not cover braces unless they are medically necessary. But there is an alternative way to pay for braces if Medicare won't. So if you didn't know, braces are expensive if you have to pay out of pocket, which most people do. And braces, according to Healthline, can cost between $3,000 to $13,000. Obviously, that's going to depend on the dentist and also the type of braces that you get. So because they're so expensive, how are you going to pay for them? So we already know Medicare is not going to pay unless they're medically necessary. Medicare Advantage plans, again, are typically not likely to cover that unless they're medically necessary. But you should reach out to your Medicare insurance advisor to see if your plan would cover them or a part of them, or if there's a plan available that, again, would pay for some or all of the braces. So where most people end up at is using either retirement savings or credit cards. And the issue with retirement savings is it may or may not be a good idea, depending on how much money that you have available in your retirement plan, as well as what the impact would be if you were to draw a big chunk of it out to pay for your braces. Credit cards, and then most dental offices offer the Care credit card. The issue with that is you're taking on more debt, which comes with a monthly payment, and that may or may not be good for some of you watching this. For others, it may not be a big deal. So what I did is I went on the Care Credit website and used their calculator, assuming you were to finance $10,000 worth of braces. The smallest payment you're looking at is $270 a month. And again, for some of you, maybe that's not a big deal. For others, that could be a huge deal. But like I said, there is an alternative way to pay for braces, and that is to use a reverse mortgage. And there's several ways to use the reverse mortgage, and there's also a lot of different reasons to consider using the reverse mortgage. First and foremost, if you had a small mortgage balance or owned your home free and clear, by getting the reverse mortgage, you could get access to income tax-free cash to pay for your braces. And that way, if you're using the funds from the reverse mortgage, it could help you retain your retirement savings instead of using that to pay for the braces. Another option would be to get the reverse mortgage and consolidate debt to free up cash flow. So you could consolidate your current mortgage, car loans, credit cards, etc., into the reverse mortgage to free up the cash to be able to make the monthly payment on a Care credit card or just a regular credit card. And finally, which I think is the most important thing beyond getting your braces, which is to be better prepared for other large expenses during retirement. So beyond just braces, you're likely to have future large healthcare costs. You're probably going to have home repairs or, replacing a roof or heating and air unit or things like that. You could have car repairs. There's just going to be other financial shocks that are going to pop up, and the reverse mortgage could have you better prepared to deal with those things when they do arise. So let's take a look at the scenario of Brian. He is 65 years old, $2,600 a month of income. He has a $400,000 house with a $75,000 mortgage. His payment is $600 a month, not including taxes and insurance, and he has $35,000 in retirement savings. So Brian is recently single and ready to mingle, but he really wants to get his teeth fixed before he starts dating, and he wants to get braces. The issue is Brian doesn't want to use his retirement savings because drawing out $10,000 is almost drawing out a third of what he's got saved, and he just doesn't feel comfortable financially by taking on a $270 a month payment, because between the mortgage and his Care credit card, he's looking at $870 a month. That is a big chunk of money. Brian just doesn't feel comfortable doing that. So Brian reached out to me to see if the reverse mortgage would be an option. And so we dove pretty deep into this and came up with 3 different options of what Brian could do. So the first option here would be to get a reverse mortgage and draw the $10,000 to pay for braces. And so this scenario is represented by this bar chart here. And so the blue represents the home value, assuming a 4% appreciation rate. And historically, that's pretty accurate. Some years it's more, some years it's less. The orange represents the loan balance, and we can see this loan balance is increasing over time. And initially, we're starting off with $102,000. That's because we're paying off Brian's current mortgage, and we are also drawing out the $10,000 to pay for braces, and we're lumping in the closing costs. So Brian starts off with $102,000, and then that loan balance increases from there. The reason the loan balance is increasing is because we are assuming that Brian is not going to be making a monthly mortgage payment. He's still paying his property taxes and his homeowner's insurance, but he's not making a monthly payment, and that's why that loan balance is growing over time. The green represents a line of credit. And so after paying off his current mortgage, lumping in the closing costs, Brian would have a line of credit of $32,000 initially. And you can also see this line of credit is growing over time. And that's because any funds available in this line of credit grow. And they grow at the current interest rate plus 0.5%. So if Brian never touches this line of credit, there's just more and more for him to use at some point in the future. So Brian wasn't overly excited about this option. So the option number 2 was to pull $10,000 from the reverse mortgage, but then he would continue to make payments of $600 a month towards the reverse mortgage. So he was already making a payment. He was comfortable with that payment. So by getting the reverse mortgage, he's just going to continue to make that payment. So again, the blue represents the home value. Nothing has changed there. But the orange, we can see, this is interesting, is pretty much just going up ever so slightly every 5 years, right? So we start off year one, day one, with $102,000 loan balance, and in 15 years, it's $112,000. Basically, by making a payment of $600 a month, Brian is more or less paying the interest and mortgage insurance that's accumulating every month. So that's why his loan balance grows so slowly over time. What's interesting, though, is his line of credit. And this line of credit is significantly larger than it was with the previous option. And his loan balance is lower, too. So looking at year 10, we can see with this option, his loan balance is $107,000 and his line of credit is $174,000. Whereas with the previous option, it was $214,000 loan balance and $68,000 line of credit. So the question then becomes, how is that possible? And it's because Brian is making a monthly payment. And dollar for dollar, whatever Brian pays towards the loan, not only pays the loan balance down, or in this case, a slight increase, but it increases that line of credit. So it's almost like Brian's putting $600 a month into a savings account that's growing. So again, that's why that line of credit is so much bigger and that loan balance is not really growing much, because Brian just keeps making the payment that he was. The beauty of this is that Brian, starting off year one, has almost the same amount of money in this line of credit that he does in his retirement savings. So we almost doubled the amount of money that Brian has on day one. And if Brian just keeps making that payment, in 10 years, when he's 75, he's going to have $174,000 sitting in that line of credit. And that's a whole lot better than having $15,000 or $20,000 in a retirement plan. So the third option, which is really interesting, is to finance the braces with a Care credit card. He's going to make the $270 a month payment on that Care credit card, and he's going to take the difference and pay $330 towards the reverse mortgage. So he's taking that, what his current monthly mortgage payment of $600, and he's going to split that up. $270 is going to go towards the Care credit card, $330 is going to go towards the reverse mortgage. So again, because we're starting off with a smaller loan balance, there's not as much interest accumulating, and by making that $330 payment, Brian is actually paying his loan balance down over time. And again, we're starting off with a bigger line of credit, and that $330 payment's going in there. And so Brian's line of credit is actually bigger over time. So what's interesting, again, is if we look at this option, so in 10 years, he'd owe $87,000 and he'd have $195,000. In the previous one, he owed 107 with 174,000. So there's about a $20,000 difference in both the loan balance and the line of credit for the better by structuring it this way. So again, it just gives him a lot of flexibility that other mortgages and other loan options don't bring, like the reverse mortgage does. So there's several reasons to consider the reverse mortgage to pay for braces. First and foremost, we're not getting into credit card debt. Now, that third scenario that we just covered is pretty interesting, where we are using credit cards, and the reverse mortgage and splitting those payments actually provides a better outcome financially for Brian. May not work for you, but in this scenario, it worked really well. So getting into credit card debt in general is just bad, but there may be a way to do it where it makes sense. The ability to retain retirement savings. So again, instead of drawing out large chunks of money out of retirement savings, we can use the reverse mortgage to pay for braces, leave those retirement savings intact so that you have them available when other expenses pop up. And the beauty of the reverse mortgage is that it creates a lot of flexibility in the monthly mortgage payment. And unlike any other type of debt that you may use to pay for braces, the reverse mortgage is the only one that's going to create the flexibility. And by that, I mean you can pay as much or as little as you want towards the reverse mortgage whenever you want. So it just gives you that flexibility. So if something happened where you had to take on other expenses, or you had a large expense, whatever, you could stop, skip, reduce, increase payments at any time. It just gives you the flexibility that no other type of loan will. Now, you still have to pay your property taxes and your homeowner's insurance. The other thing is it creates an additional source of retirement funds with that reverse mortgage line of credit. And this is something that's really important, especially when you're on a fixed income and you have limited retirement savings, because there are going to be other large expenses that are going to pop up during your retirement. Long-term care, health care, home maintenance. Those are all things that can be very expensive. And with that line of credit, we now have another source of funds to be able to deal with those things when they pop up. And for Brian, getting braces, improved quality of life, he feels better, he has more confidence. So all the way around, Brian has won by doing the reverse mortgage for all the reasons we just talked about. See if this would work for you, want to see what your numbers would look like, look at your different options. I'm happy to put those numbers together for you, happy to look at different options, run forecasting, and answer any questions that you have about reverse mortgages. And there's no cost to speak with me, there's no obligation for me to speak with me, and there's no cost for me to put any of that information together for you. I look forward to speaking with you, and we'll talk soon. Thanks.